the equivalent of the doomsday clock of how many minutes we are from a monetary regime change, I would say would be at 11:59. It seems like we're awfully close. So is it today, tomorrow? No. Is it in the next 6 months? Again, I think that for the first time, I see a potential catalyst in the near future, more than I've seen in the past. So again, watch this space.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kaastrup Larsen.
Welcome back to another edition of our Global Macro series, where today, as usual, I'm joined by my co-host, Cem Karsan, as well as a returning guest to the show, namely Adam Rozencwajg, whom we last spoke to about 6 months ago. Adam, it's always a pleasure to have you back. And Cem, thanks for joining us today as well. I'm sure this will be another fascinating conversation. It's not like anything is happening in the world right now, but before we get to all of that, how have you been, Adam? Are you doing well?
Yes, very good. Thank you. Happy to be back. We welcomed our third daughter since I last spoke to you. So some long nights where I've had lots of time to read in the wee hours of the morning, and maybe a new perspective on the world at large. So happy to be here and happy to talk to you again.
Yeah. And is the vortex also hitting you, Cem, at the moment? I know it's cold in the US.
Yeah, it's currently 3 degrees Fahrenheit outside. So yeah, you could call that a vortex. I mean, Chicago is always cold at this time of year, so it's all 10 degrees one way or another. It doesn't change things too much, but it is cold.
Well, we've got a few hot topics to talk about today in the world of natural resources, and I'm sure some global politics will sneak in as well. So what I'd love to do, actually, Adam, with you is to maybe ask you to kind of, before we dive into all the subtopics, maybe give us your view on kind of your big picture framework at the moment, but also perhaps point out some of the things that may have changed from about 6 months ago when we last spoke.
So I think a lot of things have changed in the last 6 months since we last spoke. And frankly, pretty much all of them, as far as we can see, have been very bullish for natural resources and real assets in general. I'll start very briefly on some of the supply-demand trends, and then I'll kind of zoom out and discuss a little bit more on the macro in terms of some of the changes we've seen and some of the catalysts going forward, because we're value investors, and for a long, long time, we've argued that with the commodity markets where they are, which is to say very cheap relative to financial assets, and with commodity stocks where they are, energy at 3% of the index versus 15% long-term, we've argued that timing really doesn't matter. It doesn't cost you anything to be early on these trades when you get such extreme valuations. And on the other hand, it costs you quite a bit if you miss that move. It can move quite quickly when it comes off the bottom. And I think now that's evolved a little bit, where I think the timing is actually coming a little bit more crystal clear in the next 6 to 9 months. And I think you really want to be involved now. So we'll talk about all of that here today. From the fundamental perspective, the big thing that's changed since we last talked is that after years of underinvestment and after years of restricted exploration and development, we're starting to see supply responses in a lot of different commodities across the board. That's certainly true in global oil markets. You'll recall that the U.S. has been the number one driver, in fact, really the only driver of global oil supply growth in the last 15 years. We estimate that about 9/10 of every barrel of new demand has been met by a shale barrel in the last 15 years or so. And that's now over. Shale growth has now turned negative It looks as though on a year-on-year basis, December to December was likely negative in terms of U.S. crude oil production. And the shales, all except the Permian, are in pretty sustained declines. And we can use those as a roadmap to say, when will the Permian decline? And it's already basically bouncing along at zero growth. And I suspect that that'll be an outright decline within the next month or so. So what we've been saying for a long time, look forward to a change in global oil supply dynamics. That's now here. And it's also here in natural gas. So the U.S. gas production, which has grown relentlessly since the middle 2000s with the advent of shale gas fields, has now actually turned negative by about 2 to 3% year on year. It's a big number. It was as high as down 5 Bs at one point. Now it's sort of moderated, down 3 Bs, but we continue to see month on month sustained declines. That change really has to do with a weak month a year ago, as opposed to major growth happening today. And that's in the face of a massive new demand picture. So the fundamentals are looking really, really good in both oil and natural gas. This is what our AI models have been telling us for a few years now. Our AI models, by the way, I don't mean our modeling of AI demand. I mean using AI to actually predict supply, which we've been doing since 2018. Always predicted steadfast 2014 would be the year everything rolls over. That has now happened. The same's true in uranium. Uranium is starting to see some disappointments coming out of Kazakhstan in terms of production, and Canada had announced about a year ago some problems there. So we're seeing it across the board, really across a lot of different commodity spaces. And the reason is it's been 15 years of a bear market, and it's been 15 years of massive underinvestment. And underinvestment always leads to depletion. It always leads to a supply response. Taking a little bit of a step back, looking at more of a macro picture, we've said for a long time now that if you look at the ratio of commodity prices to stock prices, that tells a really interesting long-term story. We took that ratio back all the way to 1900. And what it shows is that commodities and real assets move in these huge cycles. And when they get really cheap, you should buy them. When they get really expensive, you should sell them. And the preconditions to both moments of extreme undervaluation and then the catalyst to make things move into a bull market again have been remarkably similar over the last 150 years in terms of different commodity cycles. And what we're starting to see now, we've been saying that for a long time, but in the 6 months since we last spoke, and I think we discussed this a little bit maybe in the last podcast I was on with you guys, but we read, fascinating book by, I know, some colleagues of yours, and that would be The Rise of Carry by, the two Lees and Cold Iron. And what we concluded was these periods of radical real asset undervaluation or commodity undervaluation are actually just symptoms of a bigger cycle, and that would be a carry regime cycle that we're certainly in now. And that has actually meant that several different factors have all taken place very much along the same timeline as these big commodity cycles, with major bottoms happening in 29, 69, 99, and then today. And so what that does, we could talk about what those are in a second, but what that does is it suggests to us that this is not just a coincidence. It's not a spurious correlation. We don't just happen to have real assets really cheap. It's actually part of a much bigger causal system. There's lots of factors in play here that are driving commodity prices lower. And that if you believe that the same systems are in play today as were in play over the last 150 years, which we do, that we're on the verge now of a major reset in commodity prices and a huge bull market that will probably last 10 or 15 years. So I think kind of that, you hate to go down this path, but sort of that grand unifying view of the universe a little bit, right? The fact that all these things are slotting in at exactly the same timeline, I think is a fascinating development, and I'm happy to talk all about it.
Yeah, no, I had a little bit of a follow-up because this was on my list to bring up with you. And of course, Cold Iron, as you refer to, is also known as Kevin Cold Iron, who's the host of the Ideas Lab here on the podcast. And it is a great book that everyone should read. But so I have a couple of questions to that, because I do want maybe for you to just briefly mention in a second, what these triggers were, so people can have an idea of and putting it in relation to what's happening now. But the other thing I was was thinking about this was, in a sense, are commodity prices cheap, or is it just financials that's gone crazy and where there's no relationship between price and value anymore, which is kind of what we see in so many cases at the moment. But then the other thing, I heard you on another podcast recently, I think with Grant, where you talked about that you had seen, for example, was it Robert Friedman who developed some kind of way of extracting stones, essentially, and making them into smaller stones in a much more efficient way. And I imagine, without being an expert, also a lot of the drilling that takes place is happening much more efficiently, and so on and so forth. So maybe there are other reasons why commodities are cheaper. There's kind of a deflationary trend current in there as well. So those were just some thoughts I had when I heard you mention this just now. So love to hear what you're...
Sure. So look, I'll touch on the second point first because it's a little bit easier to address. So on the Grant Williams podcast and in lots of other places, we've talked about some really revolutionary new technologies being put out by a number of people, but I think the most exciting are a suite of technologies being put out by a gentleman named Robert Friedland. And he's the chairman, founder of Ivanhoe Mines. Before that, he was Turquoise Hill, which used to be known as Ivanhoe Mines. And before that, a company up in Canada that discovered the Voisey's Bay nickel deposit. And together, those are probably three of the most important mining discoveries in the 20th century. As a collection, I would say that's probably the best run of any geologist in the last 150 years. I should say that he's not a geologist, he's a mining executive. But regardless, that is an unheard of streak. Most mining executives go their whole career without a major discovery. A lucky few get one. The Hall of Fame is 2. 3 and now potentially 4 is almost unheard of, right? So I don't think you can dismiss what he's been up to. And he has been working for many years, sort of a 25-year overnight success on a suite of technologies that uses pulsed power to both explore for minerals much more effectively and then ultimately drill and extract rock, crush and grind rock, and eventually, that will help massively in terms of how we liberate copper, let's say, or gold even, from host rock. So you asked, is this what's driving commodity prices lower, this broad deflationary trend from technology in the resource space? And the answer is no, because none of these things have actually been put to work yet. This is all in the lab. The results that they're seeing are incredible. And what it actually does do is it gives us a little bit of concern for copper and copper supply over the medium to long term. So I'm talking 2030 and beyond. Now, none of that's in the market today. Nobody even knows about iPulse. If you asked 100 mining executives, 30 might say yes, but probably only 5 actually know what the hell they're doing over in Toulouse in France. So I would say the answer unequivocally in that particular case is no. We don't see technology that is leading to massive deflationary forces across the hard rock mining space. Is it true in the oil and gas space? That's a little bit more of an interesting question. I think the answer was yes, and now again is no. And what I mean by that is we did have a disruptive technology there. We brought in horizontal drilling and hydrofracking, and that opened up these massive shale oil and gas deposits that we knew were always there. That's what I think people don't get about the shales. We had drilled for basically 100 years to find sandstone and carbonate oil and gas reservoirs, standard conventional deposits. And every time we would drill, you would hit one and it was a good day, probably, broke open a bottle of champagne when you hit a nice oil pool. But then you always would keep drilling to determine where the bottom extent of that was. And inevitably you would drill into the shales, which is the rock beneath those conventional reservoirs. In fact, that's the rock where the oil and gas itself was created and then over time migrated into these sandstones and carbonates, which were much, much easier to pump from. So you'd hit the shale and you'd say, oh, there's all the oil and gas waiting down there, but it'll take hundreds of millions of years for it to migrate out into the sandstone above where we can then suck it up with a conventional oil well. The big shift was being able to go into that shale and rubbleize it and then be able to produce from it. So now you had this unbelievable inventory of oil and gas deposits shale oil and gas deposits up to that point, unrecoverable, that now were able to be recovered. So it unleashed this massive, massive flurry of activity, right? And that's part of the reason, I don't think people quite understand this, that's part of the reason the shale revolution happened so fast, was that we knew where they were. We knew where the best ones were. We just didn't know how to get at it. So once you unlock that part of it, it was very, very quick to lease up the land and go and develop it. Immense is not the same as infinite, as we've talked about in the past. You brought on 10 plus million barrels a day of crude oil production from the shales. You brought on 95 billion cubic feet per day of natural gas production from the shales. Massive numbers, each larger than Saudi Arabia. Together, like three, 2.5 Saudi Arabias, the biggest development in the oil and gas industry, frankly, in history. And you would be forgiven for a period of time for thinking that that was a new shift, deflationary trend, and forevermore would lower the price. And I guess it kind of did for basically a decade or 15 years. But now those fields, as big as they are starting to show signs of depletion. And we don't have the next shale field waiting in the wings. Everyone always asks me, will we just go explore and find another massive one? No, we knew where they were. We went after the big ones. Everything here is incremental, and it's not going to be enough to offset declines. So yes, I do think that there was a technological shift. I do think that's partially responsible for why commodities are so cheap today. That and a massive spending boom in the last cycle, right? We uncovered this technology, and then we raised a ton of capital to get after it. Both of those things were deflationary. That's in the rearview mirror. Copper is a concern for 2030, but for the time being, no, I don't think deflation explains why commodity prices are so cheap.
So many big things to discuss. Adam, wonderful seeing you again. Always one of my favorite conversations of the year.
Oh, thank you.
We talk a lot on this podcast and for many years now about these big macro cycles that you referred to. As Niels mentioned, Rhizo carry is at the core of kind of how we think about markets as well, never mind the fourth turning, and some of the insights gained from there. The understanding that I have and that we think about when we think about these big cycles is not just that they're some magical thing that happens, but they're a function of really this push and pull that happens with the natural system of things pushing the world towards kind of more and more inequality, a natural system. Everything goes, all the gains go to the top. And eventually inequality getting to a point where a whole generation, that's why it's 40 years or 2 generations, right? All of a sudden having experienced that inequality, rebelling against it all of a sudden. And then you enter these periods, right, of populism and protectionism, and everything goes the other way for 20, 30, 40 years. So this is this generational kind of experience, which for the fourth turning talks so much about, is so important to these cycles. That said, these are big, long cycles, right? And you can have years within these cycles, sometimes 5 years, where things within that cycle go the opposite direction. And obviously we talk every 6 months, right? So people are like, what's happening in the next 3 months, 6 months, year? So I think the timing part is so hard, right? And we are dealing with a weighing machine, as we talk about, right? In the words of Benjamin Graham, versus a voting machine. And I think nowhere is that more prevalent than in commodities, because supply and demand in those markets can get imbalanced, and things can, as we've seen, be priced incredibly cheaply or incredibly expensive for some periods of time, and be so very inefficiently. So my question is really, at this important point, new administration, new approach, is this the moment, right, where in terms of timing, supply and demand, and when I say supply and demand, not in the commodities themselves, because I think of that as really the weighing machine. Yes, that does play into the supply and demand in markets as well, but really market positioning, market timing. Why would this now be the moment, in your thoughts, meaning for the next year or two, to really be getting long fundamentally, right? We agree there's a big cycle coming, but again, for 5 years, that could not work. I would love to hear your thoughts a little bit about that. Why now?
Sure. So I'm going to hedge at the outset and say that when commodities do get this cheap, the timing, as we've shown, actually doesn't matter. And I find, these numbers are staggering, but commodities first became cheap relative to financial assets, stocks, in 2015. It crossed a threshold that was only ever breached 3 times before: 29, as I mentioned, 68, 69, and 99. And then it first broke that level in 2015. And since then, it's kind of been trading slightly down to sideways, commodities relative to the Dow. We use the Dow, but if you use the S&P, it's the same thing. And what we noticed is in the past, again, if you bought it when it first got cheap, even if your timing, even if you were the super value investor, right? You didn't want to market time anything. You just said, look, empirically, it's as cheap as it's been. I like it here. Now's the time to buy. We noticed that first that occurred also in like 53, 54 and persisted all the way to 68, about 13 years. And if you owned a basket of commodity equities over that period of time, you actually performed in line, slightly better than the S&P 500. And believe it or not, since 2015, you've basically been right in line with the S&P again, right? Which has been a good run for the S&P. So it's not like it has been dead money. It's not like it's been frustrating from a observational perspective, but if you actually kind of look at your numbers since then, it's been okay. And that's where we get this idea of there's no cost to being early. Now, of course, we're already, 10 years into that period of being radically cheap. So I suspect it doesn't last another 10 years, right? We're closer and closer to the 68 takeoff point, the 1971 massive rallies in commodities and natural resources. And yet the cost for being patient thus far has been market returns. And so I think that the risk return is certainly in your favor. Now, having said all that, I do think that the timing is now. And we have, our new letter is going to be due out in a week or so. And we'll be discussing this, in great depth and detail. But it has to do with the fact that every major commodity, real asset, relative market bottom was ended and a new bull market started based on a change in the monetary regime system. And we've been talking about that since 2020. That's when we first made that observation. So it's been 5 years already. And we weren't calling for a major change just yet, but we were saying, keep your antennas up and look for a change in the monetary regime. Now, what do I mean by that? Well, if you go back to the 20s, most European countries suspended their gold standard during World War I. Britain notably tried desperately to get back on in the interwar years. And through the 20s, Benjamin Strong, New York Fed, decided to undertake quantitative easing. We were going to print US dollars with a strong US economy. It resulted in the massive stock market boom we saw in the 20s. Strong called it, he's going to give the market a coup of whiskey. And he sure did. And the point was to try to devalue the US dollar, get the pound revalued so it could go back on gold at its pre-war rate. Strong dies suddenly in 28, and his controversial policies were completely undone. And what you saw was ultimately the stock market crash in 29 and the depression. And that was the end of the gold standard. I would call that entire experience the last nail in the coffin of the gold standard. Certainly a monetary regime change. That had been, a hard gold standard had been what we had in place since the Napoleonic Wars. Yeah. So definitely a monetary regime change. 68, 69, 70, when commodities bottomed again and then took off, of course, that corresponds to the end of Bretton Woods. And I think I probably mentioned this last time. This is like my fun little bit of trivia. Nixon gets blamed for taking the dollar off gold. He definitely closed gold convertibility. He closed the quote unquote gold window. But really it was Johnson who signed a law in 68 that said that the dollar didn't need to be backed by gold anymore. It'd be equivalent to banks throwing out any capital requirements. The day that you strike those off the rule book, you don't necessarily go broke. But certainly within a couple of years, you'll have a run on the bank. And that's what happened. And so finally, they had to close convertibility in 71. That was the end of Bretton Woods. 68, 71. It's hard to tell on a chart. Or, I would argue 68, which corresponds exactly to the bottom. Others might say 71, which corresponds to the bull market and resources really starting to take off. And in 99, it was the fallout of LTCM. All these Asian currencies had pegged themselves to the dollar at a fair value. The idea and the understanding was that the IMF and the World Bank would provide liquidity swap lines in the event of a currency hot money flight from the Southeast Asian countries. That happened following LTCM. The World Bank and IMF did not step in. And in the aftermath, which saw these currencies, devalue 70% in some cases, massive economic turmoil throughout Asia, the countries all said to themselves, well, to hell with this. We're going to peg below market and we're going to spur our exports. We're going to make our economy and our export market super competitive. And it resulted in, 5, 9, pick the number, pick your timeline, but trillions and trillions of dollars in U.S. treasuries ultimately flowing east. It created the dollar recycling standard that, is in place today. It brought on the GFC, all these types of things. Again, a massive currency monetary regime change. So when we came away with this conclusion, we said, look to these markets, look to these systems and changes and fractures therein to give you a sense for when we might get a catalyst to start the new bull market in resources and commodities. And I think we have that now. Now, if you'd asked me 2 years ago, in full disclosure,
I think we did, Adam.
Yeah, we felt that the BRICS countries were likely going to be the agents of change here, in the sense that Brazil, India, China, several others were coming together and looking to start a potential rival to the U.S. dollar for international trade settlement. It wasn't clear how it was going to work yet, not all the details. Every BRICS conference, they were going to announce this new major currency. Indeed, we did see, I think, about upwards of 9% of global commodity trade move away from the dollar, big number. Places like France selling LNG to China settled in renminbi. The big question was, would Saudi Arabia sell its oil into China in renminbi? But lots and lots and lots of talks and whispers about a potential challenger to the US dollar as a global reserve currency. It wasn't clear, again, how you would do that with the renminbi in a closed capital account, but the idea was probably that gold was going to play a role to help balance out any trade settlement imbalances. And you saw all these countries buying huge gold reserves. So if you'd asked me even a year ago, I would have said, watch this space and monitor what's happening very, very closely. However, I think today, February 20th, 2025, the likely change in the global monetary plumbing or system could actually come from the United States itself. And what I mean by that is, Treasury Secretary Bessent has spoken about several, what I would call, revolutionary or certainly new and different changes to U.S. monetary and international policies. Everything, probably the most notable one that people are talking about right now is the idea of, quote unquote, monetizing the Fed's balance sheet or the assets of the Fed's balance sheet, by which I think even Bessent has said this, and lots of people have been speculating, could that mean revaluing the Treasury's gold holdings, which today are held on the books at $42 an ounce, a far cry from the market price, obviously. Even just the tariff systems that are being proposed today are quite different than anything that we've seen. So before, if you had a sort of US dollar recycling system that had been in place since LTCM, whereby the US was the reserve currency, people had trade imbalances, the trade imbalances resulted in excess treasury issuance, which then found their way to foreign central banks. That model, I think we can all fairly say, is probably over. And I don't really know what the new model looks like exactly, or even broadly. However, to the extent that it's going to be the catalyst to re-rate real assets, I don't know that it matters what it looks like. Like, lots of people have asked me, oh, is this the end of the US dollar? I said, listen, if you stood in 1971 and Nixon had just closed the gold window and gold convertibility and unilaterally taken effectively the world off of Bretton Woods, and you canvassed economists, I got to find this poll. I don't know if one exists, but it'd be fascinating to see. And you said, what does this spell for the US dollar going forward? Everyone would say, well, that's it. Say goodbye. Not sustainable anymore. And yet the dollar gained relevance in terms of a global reserve currency. Similar following LTCM. The idea was, we'll trade with you at a par dollar so that you'll bail us out if need be. And whoops, you don't have the central bank put the way you thought you did. What did that do to U.S. dominance on a reserve currency? It became massively more important. So I don't have nearly enough hubris to predict exactly what this looks like and where the U.S. shakes out. But what I'm hearing, either from the BRICS, I mean, those guys haven't gone away, or even internally in the U.S. from Treasury, I would say that, the equivalent of the doomsday clock of how many minutes we are from a monetary regime change, I would say would be at 11:59. It seems like we're awfully close. And then you start to ask yourself, well, from a timing perspective, what could that look like? And, presumably the administration, if they have all these really bold, differentiated visions on how we should operate, you probably want that to be in place decently early, particularly with, midterm elections in 2026. So is it today, tomorrow? No. Is it in the next 6 months? Again, I think that for the first time, I see a potential catalyst in the near future, more than I've seen in the past. So again, watch this space.
Yeah, I couldn't agree more. We've talked here about the parallels between Trump and Nixon well before Trump got reelected here. Only Nixon could go open up China. Only Trump can have a détente, if you will. Only Nixon could take us off the gold standard, right? Only a disruptive figure like Trump can do something similar. It's not a coincidence in the arc of history that these things rhyme. People are in the phase of burn it down, and that brings a disruptive figure that can make change. Now that change, we can argue, may not be the change people want, or maybe, and much like Nixon in a burn it down regime, eventually the hordes come for you as well, as they did for Nixon. So, not a political comment, just that people want to burn it down no matter who. Being an incumbent during these periods is not a good thing. That said, at the end of the day, it is a time of disruption, and the overwhelming arc of history shows that it is a time that people will, some way or another, at some point force change. And I agree that is the most likely thing, that when it comes, and it will likely happen, I agree with you, before too long, given that the agent of change is now in office. I think that is a major issue. I think, the one thing I think about when I think about the weighing and voting machine, as we mentioned, is, there's this idea that, the voting machine, supply and demand, is like the fuel on an airplane. You can keep going in the wrong direction. Gravity is the valuation, right? But things coming back in line really happen when that fuel turns off, right? How far you are off the ground is all that matters. At the end of the day, when that liquidity gets cut off, and that could happen, as you very astutely mentioned, through an emerging market crisis, through disruption and liquidity getting removed by kind of the dislocation that's happening, which I think is a very high probability in this regime, as you mentioned.
You talk about disruption and change and things like that, and obviously you have a lot of echoes of Neil Howe and the fourth turning, and we are big fans of Mr. Howe's work. He spoke at our conference last year. We know him quite well, and the fourth turning has made a huge impression on both Lee and I, and his new follow-up work, The Fourth Turning, is here. Which, if people haven't read, I don't know if this is bad for his book sales, but you probably can read the follow-up. It does a good job at summarizing the first volume and then updating it. But getting back to change and the idea of change shocks and things of that nature, and the rise of carry. What I think is really interesting in the rise of carry, they basically talk about the carry regime that's in place. Basically, you pick your timeline, but I would say, call it from 1980 to today, but really, the last kind of 15, 20 years, right? And it's been characterized by a number of things. It's been characterized effectively by a levered short volatility trade. So the idea that, the classic carry trade of borrowing in yen and investing in Australian bonds represents arbitrage, a leverage on the trade to make it work, or to produce an acceptable level of return, and you're effectively short volatility. So long as the structure is the same tomorrow as it is today, the trade will work. You're picking up the pennies in front of the steamroller, which is nothing if not being short volatility. And they talk about a number of characteristics that all kind of line up with that, like the outperformance of growth over value and of momentum, because, growth, first of all, as you reduce volatility, you reduce interest rates, you suppress risk, you have a convergence in a lot of different costs of capital. What it ends up doing is you end up pricing and more highly valuing farther out cash flows. It doesn't seem quite so scary in a short vol world where you are suppressing volatility by the very trade to all of a sudden look to these big conceptual stocks and look to things that have 50 times, 60 times multiples, because just like bond duration math, when interest rates are low, all of a sudden that works out quite well. But, we've seen those trends actually take place a couple other times. And all of those, and these guys don't really talk about it so much in the book. They allude to some other carry regimes, but they don't study them in depth. Their book would probably run to 800 pages if they did. But it turns out the 20s were exactly the same. If you look at the performance of value or underperformance of value relative to growth, if you look at the concentration, if you look at market cap of the equity markets relative to GDP, the statistically different periods are all 1920 to 1929, 1963 to 1968, and 1992 to 1999. And then today. And you start to see all these things repeat themselves. And so I would argue that what we're in right now is a huge carry trade, that the real assets lose their luster relative to these big conceptual, abstract, multiple growth stocks. A company that has a factory that'll generate widgets for 15 years and you can run that DCF, that maybe will trade at 1 times NAV, whereas the company that promises disruption can trade at 60, 70, 80 times earnings and 10 times book value with no problem, right? And then the catalyst to undo it in every case has to be what the authors would call a carry unwind, right? Or something that introduces volatility back into the system, right? A volatility shock that all of a sudden makes people price these two disparate asset classes differently. And that's where you get, I think, these monetary regime changes have to be that, or usually historically are that agent of change, right? Certainly when you took the US dollar off gold in 71, that was a volatility shock. That was not the same market going forward as it was before. And if you have this, multi-trillion-dollar levered trade on that's all betting on suppressed volatility and tomorrow looking exactly the same as today, you get the unwind of that when you change the underlying system. That's really the only thing in a lot of cases, I think, that can change it, because the trade is so reinforcing. It self-reinforces because more money pours into it. Growth does better. And so more money goes into it and then it does even better. And then they can make acquisitions and it's the nifty 50 all over again. So I think that the big kind of takeaway, which is a little bit alarming, frankly, for a lot of investors, is that yes, natural resources super cheap, commodities super cheap, catalyst probably here. By the way, the fundamentals, right, for those who care, the counting of barrels, looking at rig counts, incredibly bullish and positive. The lack of exploration, super bullish and positive, right? But not only will that work, the problem is that almost every other investment in the world today is caught up in the carry trade. So I worry for people whose portfolios, they look at it and they say, look, we've diversified. We have a little bit of US, a little bit of Europe, a little emerging markets, and we have some private equity and hedge funds in there as alternatives to really diversify and protect ourselves. You guys, no, I'm sorry. That's all the carry trade right now. There's nothing that's more carry trade if not private equity, which is effectively just a levered S&P return and a preferential fee to the manager. So I worry that, in the event we do get a carry unwind, people are going to realize their portfolios are not nearly as diversified as they think they're. In fact, they're what I would call, Texas hedged. You think you're hedged, but you're really doubled down. And that's the state of the world today. And I think it's very precarious. And I think investors need to be looking all across the market for anything, just on the margin, not even to tactically reposition yourself, but just to protect yourself at the very least against the fact that we might all be in the same trade in almost everything. And resources, I can definitively say, are not in that basket.
Yeah, we 100% agree on that. And the key is the timing, as you mentioned. And I agree with you. At the end of the day, at this point, the risk reward is so dramatically in your favor. It's okay to be early because the coming move, when it happens, will be quick and decisive. But again, it could be years.
I'm going to say 6 to 9 months. When I come back on in 6 months, we can do that. I think we're approaching it quite quickly.
I think we're 6 to 18 months away, and I think there's several reasons for that. But I agree, it is closer than people realize. Given that metaphor, I was saying essentially liquidity, by the way, is the reason that markets that carry trade across the board. As long as there's liquidity, the carry trade maintains, and the carry trade is really a skew trade, whether it's in the S&P, it's downside versus upside. There's a structural phenomenon where vol and skew, or kind of talking my language here, the vol and the liquidity can be pinned, but the tail, it happens once that vol compression is released. And so what we're beginning to see is that vol compression, even though at this very moment it's very well supplied in very short term, but the actual liquidity is reducing dramatically. That fuel in the tank is getting really low. And even though that's the case, we can glide, like the plane can glide for a while. But a little bit of a disruption, a storm, something that all of a sudden, now that the fuel is gone, kind of forces some disruption, turbulence. You're too far off the ground, right? The fuel is sputtering. You're too far off the ground. I think we're really heading to a period in terms of volatility that we're looking for a catalyst, but the liquidity is coming off the table. I completely agree with you. And just a little bit of an insight here in terms of how these things usually end. It's one of two ways. One, it's a narrative change, which is not something we've talked about here, which I think could be the case here in a Trump administration, where people all of a sudden start to say, well, wait a second. All this demand side economics populism we've been seeing, even though he's been talking about a rhetoric, he's reaching across to China and there's a détente. He's going to do more supply side economics, all these things. Maybe especially after some period here, right? People begin to lose faith in the energy trade. People lose faith in the commodity trade. If that happens, it's actually the best thing that can happen, in my opinion, given this regime, to actually accelerate a potential move. I think we've had this problem, and this is why things last longer than you always think, right? Markets can stay irrational longer than you can stay solvent, because people see the thing coming. It's pretty obvious to those that are kind of looking at it. You need a loss of faith enough so that the supply and demand in the short term can become imbalanced, and then the bigger move can happen. And so that's one thing I'm really looking for here, some type of a narrative change where people actually begin to lose faith in the reality of what we're talking about. That would be great for the trade, candidly. And then two, the other way it could happen is sometimes people don't lose faith. It is just such a big shock, as you mentioned, right? Which I think could be an emerging market crisis in the face of, I was just in Turkey, actually, talking to a lot of big Turkish kind of traders, businessmen, et cetera, people really embedded in the country. And what people don't realize is how fragile some of these emerging markets already are, right? And that's amidst a global, really not a recession. Like the economies are doing well. The world is full of generally liquidity from markets, et cetera, in the developed world. What happens if we go into a global slowdown? What if we have some disruptive forces amidst that, right? That could really cause a big, in a fragile emerging market, a big crisis, especially if that means stronger dollar, especially if that means, if there's some disruptive moves by the Cent and the coming new Federal Reserve Chair, whoever that is. So there's really two paths here, and I agree with them. One of the two are likely to unlock this trade we're talking about, but the time is coming.
No, listen, I agree with that completely. I think I got most of it. I think I agree with all of it. But I'm just going to make it a little simpler, because I'm not an options trader, although I have traded some options, in the past, but I'm not nearly as well versed as you are. But in your short vol, pennies in front of the steamroller skew type of a model, there's periods of time where the likelihood that tomorrow looks very similar to today is higher and lower. In fact, most of the time, tomorrow does look exactly the same as today. And then there tends to be the days where, it's very, very different. Tomorrow looks very much like today up until the day you die, I guess. And then it's a very, very different day. But when you go back, let's say a couple years, right, and we had massive U.S. deficit spending, which obviously we still do, and those excess treasuries were all being effectively monetized through the banking system, but still being monetized by the Fed. And everyone, 100 economists in Bloomberg were calling for a recession, and we were never in the recession category. And you looked at it and you're like, why would this change? This isn't going to change so long as the U.S. can run these crazy deficits and place the bonds. And right now, no one's buying the bonds. It wasn't, the foreign central banks were buying bonds. It was really being acquired by the Fed until they lost control of the 10-year and they had to move to bills and all that. And you say, well, tomorrow's going to look a lot like today. Today, I think, is very different. When I look forward and I say, what's the likelihood that a year from now, policies across the board here resemble what they resemble today? And these are not little policies, not small tweaks. These are potential big ones. Everyone seems aligned that they want to change things. And so I think, it might be just as simple as that. You kind of look at it and you're like, the likelihood that this administration in a year from now has everything aligned the same as it did a year ago is pretty low. In fact, I'd say almost zero. And that's, I think, what puts some of the carry trade stuff at risk because, again, you start to get the unwind when the volatility picks up, when the regime changes, when things are different. That's when you start to have a forced unwind of a lot of this stuff. And then it could be just self-perpetuate, right? As it starts to unwind, it forces further unwinds, which increases change and shocks and volatility more. And that's where you get your crisis that pops up somewhere, whether it's emerging markets, whether it's, leveraged regional banks in the US. It's hard to say exactly where it's going to be, but with so much leverage in the system and things set to be so different, I think, or the potential for them to be quite different. And everyone with a levered short vol trade on, that would be the first time in market history that having everyone in a levered trade in one direction, that the masses are right. I just don't think it's going to happen.
We talked a lot about sort of the changes that the Trump administration is coming with. We talked about that we need some kind of catalyst. We talked about that this would have an impact on commodities. So I want to try and tie it all together in a sense that from where I sit on the other side of the pond to you guys. It looks to me like the new administration is somehow, it's weaponizing commodities in a sense, right? It's going after Canada, it's going after Greenland. Now it's talking about Ukraine and rare earth has to be part of any peace and etc. So from your perspective, Adam, when you see these things happening, suddenly commodities are, I don't know how to phrase it, but it's taking on another role suddenly. It's not just something we produce in one place of the world and it's friendly sent over to another place of the world and it's used over there. But how does that change your and you say that the oil supplies is levering out in the US and maybe that is why he wants Canada and Greenland for who knows. But how do you think about something like this? Because I don't think this has ever happened before. That commodities plays like a geopolitical role. Well, maybe it has, but not that I remember.
Well, I mean, certainly in World War II, there were major moves that were done to secure energy supplies. Particularly by the Japanese and their incursions throughout, the South China Seas and the broader kind of Asian continent to try to secure supplies. And frankly, big moves by the British as well to have coaling and refueling stations for their blue water navies. So I think we have seen this. I'm not entirely sure that we're seeing a weaponization of commodities today. When I think of a weaponization of commodities, I really think, probably the prime example of that would have been China with rare earth metals back in 2010 or so, where they they mined and then processed basically all of the world's rare earth metals that went into all kinds of things like magnets and electronics. And they restricted output to Japan, notably, for geopolitical leverage and things of that nature. Basically what they wanted was all the battery technology and magnet manufacturing technology to be brought into China so they could steal the intellectual property. And when Japan didn't want to do that, and they said, no, just you give us the rare earths and we'll make the stuff here, they said no. And that forced a pretty big realignment in a lot of those trade routes. That was pretty mercantilist and pretty aggressive. Are we seeing that today? I think it's a little early to say that. I think certainly what we're seeing today is a renewed appreciation for some of the fragility of the supply lines in the raw material space. Lee and I were talking about this just last night, that through the Cold War and into the early 1990s, the U.S. maintained strategic stockpiles of lots of different things. Those were all thought to be redundant and superfluous, and were liquidated. And, when you look at anything from antimony is a big one, where, the U.S. is now providing loans to U.S. antimony potential mines so that we can have domestic supply. Uranium, where we used to be both the world's largest producer of mined uranium, and then importantly had a huge enrichment facility here as well. Now we basically don't register on either of those things. Those are trying to be moved back into security of supply. Lots of different things like that. So I don't know that we're quite at the weaponizing phase, certainly not in the U.S. I don't think that's a fair assessment yet, but I think there's a renewed appreciation for security of supply and the idea that it could be a strategic vulnerability, in a little bit more of a hostile world going forward.
We talked kind of bigger picture, right? For the last bit here, I would really love to kind of get more specific to different commodities. I mean, you mentioned yourself that copper and copper and uranium are going in likely going in different directions. So we have a universal view, right, of fundamental things with fundamental hard value and their importance. But I would love to drill down a little bit and talk about, we have very disparate things like gold and precious metals, right, and uranium and copper, right? Where do you see the greatest opportunities currently? And specifically, I would love to focus on uranium and also gold, and hear your thoughts kind of about precious metals as well. And then also maybe energy writ large. We've talked about a little bit of the supply and demand imbalance there, but I'd love to get a little bit more specific, and particularly as we sit here.
And look, you're absolutely right. If you look at commodities in general, they tend to move in these big cycles. However, within that, there's certainly ability, and not even trading, investing over a multi-year timeline, there's definitely excess returns to be generated by picking the right places at the right time. And we spend a lot of time doing that. So if I'm talking to somebody about an asset allocation in their portfolio, I might talk about the asset class and commodities and resources in general. If I'm talking to someone who buys the story and wants to know where we're thinking, there's times where copper becomes radically undervalued relative to energy, relative to itself, whatever the case may be. I think right now the biggest dislocations are likely in U.S. natural gas, where U.S. gas today remains 80% below the world price. And there's a good reason for that. It's been that cheap for a long time. And the reason is we've had just so much supply from the shales. We've shut down most of our coal-fired power. We've gone from being a big LNG importer to a big exporter. We've built all these petrochemical facilities. We've done a lot to soak up that gas, and there's still been too much. So that's why it's dislocated from the rest of the world. Our contention, though, is that in a period like we have now and upcoming, where electricity demand is set to go through a huge shift higher because of AI data centers and things of that nature, and U.S. LNG exports are coming online, 7-8 BCF a day in the next 2 years or so, big numbers, at the same time as production is now declining for the first time in 15 years, that disparity with world prices could be closed quite quickly. We've been early on this trade. For anyone that's followed us, we've been basically 2 years early because of 2 back-to-back mild winters that we had that eviscerated natural gas heating demand. This winter's been more seasonable. It's actually been a bit colder in parts. But we're now starting to see the impact. We're starting to see inventories that decline quite sharply. Production continues to be really, really weak. It's down 3+% year on year. It's not going to get better anytime soon. And I think now we're at massive risk of pegging that U.S. gas price to the world price. That could be like a 3 to 4-fold move in gas quite quickly, depending on weather in the short term. So that's probably the biggest dislocation in commodity markets today. Uranium is also in a really bullish situation, and it's a very interesting and kind of opaque market. I'm sure we've talked about it in the past here too. The idea is that with uranium, things don't develop on a week-to-week basis the same as they do in the oil markets or the gas markets. You don't get weekly inventory numbers, the market moving data coming out every week. You have to take a little bit of a bigger picture view. And where we are today is the market's in pretty sharp deficit. We have not brought on enough new capacity in the last 15 years. Partially that was due to expectations that we would continue to retire nukes around the world. That didn't happen. In fact, now we're giving them life extensions. We're bringing back on shuttered plants. And of course, we do have new build programs in places like China and Korea as well. So reactor demand today outstrips mine supply. Inventories are basically almost zero. Post Fukushima, we had built up all these excess Japanese commercial stockpiles that could be fed into the market when supply was less than demand. That's not true today. And for the most part, the term uranium price, which is to say where fuel fabricators contract with miners and stuff like that, that's been going up and up and up. That's 90% of the market. What has been a little bit weak has been the spot uranium price, which fell last year, even though the term price went up about 20%. The spot price came down by about a comparable amount, and that's because a year prior to that, a whole bunch of speculative money came in and was playing spot uranium from the long side. I think that's all gone now, and that's obscured the narrative a little bit, but the fundamentals remain super positive there. There's no real major new mine supply coming online until the Rook Arrow deposit up in Canada comes online in 27, 28, and the big question mark there is, can that come on in time? And I suspect the answer is no. We own the stock because I think if they say they can't come online, probably uranium prices and all the uranium stocks go up a lot. But that's an aggressive timeline. It's debated in the industry whether they can make it. Who knows? We'll have to wait and see. But the market looks quite tight physically, and demand is very, very strong. Gold, you wanted to talk about the gold market. Gold is a super interesting market. Obviously, gold prices making new all-time highs every day. And that still today is basically with almost no Western participation in the gold market. We have no big Western buying of gold. In fact, shares in the GLD are flat to down, and the GDX, which is the gold shares, are seeing outflows every day. So it's basically been central banks. We had a little bit of time of Western buying along with central banks. That took gold prices up another leg. But right now, it's the central banks buying, and it is the Western retail investor, I would say, neutral. That leaves a huge amount of buying power left to go. And I suspect that will continue as gold prices move higher. The Western investor or the Western speculator, whether it's retail, institutional, what have you, they are pro-cyclical. They chase price. If you put $4,000 on gold in the next 2 months, there would be more demand for gold investment, not less, right? The Eastern physical buyer is the opposite. They're super price sensitive. If prices go up, you see them step out of the market. The Western guys, when prices go up, they come in with more force. And the central banks, of course, are completely price agnostic. They don't say, oh, I think gold's a good buy here. Let's go buy some ounces. What they say is we're going to change our policy and hold more gold. And then they go and do that. So I think you have two potentially, very bullish buyers on the horizon. That would be the central banks and the Western investors. And so I suspect the prices will move quite a bit higher from here.
Related to gold, I have a couple of questions actually. So one, we don't really talk that much about Bitcoin and to the extent, that's not a commodity, obviously. But I do think that obviously gold is not a, industrial commodity as much. The value is more like a currency, right? And so, akin to Bitcoin in that way. There are some that have argued that this time around that gold will have less demand because you have a Bitcoin kind of alternative, and that particularly a certain part of the generation that's out there at this point kind of driving some of these changes, millennials on down, to see that as a store of wealth maybe more than gold. Do you have any views on how this time it might be different in terms of gold on this cycle?
I think that's going to end badly for millennials. I'm not a believer in Bitcoin, and I have some fundamental reasons, and then then I'll tell you kind of a markets-based reason. So first off, I do appreciate that Bitcoin is an asset that's outside of the financial system. It's an asset that you can own sort of independently, and that's always been a big benefit of gold. It's an asset that's no one's liability. Obviously, gold has served as a store of value in a much better way for much longer than Bitcoin has. Now, one of the interesting reasons as to why that is, and some people make the case that if you look at the long run increase in the supply of gold, for whatever reason, right? There's short-term dislocations if you come up with, the gold rush in San Francisco and in the Yukon and stuff like that. But if you look over thousands and thousands of years, the increase in supply of gold, above ground gold, of which, 99% of all the gold that's ever been mined is still accessible, has basically mirrored the long-term real GDP rate. Including, pre-industrial revolution, it was lower, GDP was lower, and then industrial revolution both helped GDP start to grow and helped gold miners effectively bring out more gold. So really kind of interesting, and they've moved in lockstep. And so that argument says, look, if you started out with 4 different economies, societies, one that used seashells, one that used pine cones, one that used gold, the seashells, the rate of seashell growth would be above GDP growth, and you'd have inflation, and there would be turmoil. And as you talked about before, that would lead to inequalities and ultimately revolution. Pine cones wouldn't grow fast enough, and pine cones probably would, but pick one that wouldn't grow. Diamonds, right? Diamonds wouldn't grow fast enough. You'd have deflation. There'd be equal imbalances. And the society that picked gold would kind of self-reinforce over time. So you compare and contrast that. It's hard to test the counterfactual, but you compare and contrast that with Bitcoin, where we know that its supply is not going to grow properly, or not going to grow in line with, it's going to asymptote. It's not going to grow in line with GDP. And you wonder if that's going to serve as the right long-term real store of value. The other thing, of course, even simpler than all that, is just it's a huge energy hog. It's massive. And the more you use it, the more energy it's going to require. So if you start to look at what these hashes will require as computing power gets thrown at it, and as the value of Bitcoin were to go up, you'd end up consuming, huge quantums of energy. And if you think, as I do, that energy is ultimately the lifeblood of the economy, at a certain point, the economy will collapse under the weight of all the energy being used to mine Bitcoin. And I don't think that that's sustainable long term. So those are my reasons for that. If you look at a market on a more markets perspective, I think the question you have to ask yourself, getting back to the conversation we had before, is Bitcoin a carry trade asset or not? And that's a really interesting question, because one of the nice things about gold here is that it is an anti-carry trade asset. And I would argue that Bitcoin is traded more like a tech stock, like a high duration bond, or like a high multiple valuation company. Now, is that fair? Is it not fair? I don't know, but I think that's who's buying it. And so I think there's a big risk nearer term with Bitcoin, particularly if we have some of the events unfold, and when people say, oh, won't Bitcoin take away all the demand from gold? I mean, certainly not if Bitcoin ends up trading like Microsoft, Meta, Google. Then no, I think that's going to have a huge inflow of Bitcoin investors dumping Bitcoin and saying, we should probably have some of this back in gold. If that's not the case, then, it's an open question. But I think just look back at 2022, that 2022 is a really seminal year because it showed what the real carry trade unwind looked like. And it showed that a lot of assets that should have behaved differently, stocks, bonds, what have you, didn't. Incidentally, we had a good year that year. And Bitcoin had a terrible year that year. And so I would look to that, and that would be a big kind of canary in the coal mine, that if you do have regime change, or you do have a shift, or, a dislocation, will Bitcoin give you that exposure? And I think the jury is out. And if you had to ask me to put my dollars at work, I think you probably know where they are.
I think you make a great point about risk, right? Like there's so much unknown, right? And on a risk adjusted basis, it does seem like gold is probably a better bet. Last thing related to gold, what do you think about the gold, the rumors of Fort Knox kind of gold not being as much as people think it is, right? There's a lot of things swirling around about there's no audit of that gold. Is it really the gold? Now, as gold's importance increases, as the talk about revaluing kind of the gold reserves, as you mentioned, comes up. There's conversations about that. Do you have any thoughts on the U.S. gold reserves?
I do think that there's often conspiracies around gold holdings. I think gold lends itself to conspiracies because that's part of its appeal and allure, is that it's not, infinitely trackable in the same way that, registered stock certificates are, things of that nature. So I think probably, frankly, having a little bit of conspiracy swirl around gold is probably good for gold in general. It's a little bit like, when you watch The Crown and they say all the pomp and circumstance and all the mythology around it is what gives it its power. I mean, part of it is that gold is anonymous. And so I think there's always a lot of conspiracies around gold. I don't have any reason to think that all the gold in Fort Knox is there. I think that it is. And I think that in general, sometimes these conspiracy theories, when they come out, a great one was kind of in the silver market back in 2021, I think it was. And that's when the Reddit crowd got into silver. And this big rumor forever was that, JP Morgan had this massive short silver position. None of the silver was where they said it was. It was all uncovered and naked and goes unreported to try to keep silver and gold prices down, to keep the dollar looking good and stuff like this. And they said, let's squeeze the JP Morgan the same as we did GameStop. And it very clearly didn't work. It lasted about 2 days and then it came back down. So is that signs of even more market manipulation, or is it signs that maybe the imbalance is not there? I think it's the latter. I think everything's kind of fine.
As you mentioned, in the short-term, narrative can be incredibly powerful and eventually can effectuate a real big change in revaluation, even though that may not be the real cause. So, but I will say, I'm not a conspiracy theorist by any means, but we do live at a time where conspiracy is more likely to be real than maybe other times. Going back to nuclear real quick, a thought I've had, which I think is really interesting, is, the last time we're likening this among other periods to the 60s and 70s, right? We drew those parallels between Trump and Nixon. And obviously, one of the big things for commodities was the OPEC crisis, right, in the 70s. I see that as very connected to, both the Vietnam War, which was inflationary, and the fiscal spending and the Great Society program. All these things are connected in a way to populism, and I won't go through all those details. But it's a time of deglobalization, right? Global conflict, and entities who have power over commodities will use that as a bludgeon, and you get disruption because of that. So that's what the OPEC crisis, in my mind, was about. I don't think that's that energy is as likely to experience that because the U.S. has so much now, Canada, et cetera, allies. OPEC has less control, I would say. I'd be curious to hear your thoughts about that, but I'd be curious to hear if there was a commodity that is very controlled, potentially by certain entities globally, and prone to, in a world of global conflict, to supply constraints, artificial supply constraints. Which one do you think it would be? And by extension, do you think there's an odds of in the next 5 years or so, some type of big supply disruption in that commodity? I see that as an increasing probability. And again, a way to maybe tease out what commodity might have a parabolic move in the next several years.
Well, look, it's interesting. I wouldn't write off energy and oil just yet. What's kind of fascinating is that, remember, from Colonel Drake to 1970, the U.S. was a behemoth in terms of oil production. And nobody in 1970, 1971 expected the United States to roll over and suffer declines. It was a huge player in the global oil markets. And King Hubbard is, the Shell geologist, predicted in the late 50s or mid 50s that by 1970, 1971, U.S. oil production would roll over, and it did. And that's what gave OPEC incremental pricing power and market share, and like you said, allows them to use oil as a weapon throughout the 1970s twice. Once after the Yom Kippur War, where the U.S. supported Israel, and once after the Iranian Revolution. The U.S. today looks just as precarious as it did then. again, you had years of million barrel plus year-on-year growth in the lead up to 1970, and then that stopped. You've had here years of growth, million and 2 million barrels, and now that's stopped. And so I don't think that we're immune from such a dynamic today at all. And remember, Nixon back in following the Arab oil embargo is the first one, put in place Project Independence, where he said, look, very similar to the Three Arrows. He said, look, enough's enough. We haven't tended to our garden enough here. We haven't made sure that our domestic supply is robust. And now production's falling and we're beholden to potentially hostile countries. So we're going to encourage guys to drill. We're going to deregulate. We're going to raise the oil price, because back then it wasn't so much a price issue. It was a security of supply issue. So let's help raise the oil price, give these guys the incentive to drill. And they did. They drilled huge. They increased the rig count fourfold in the next 10 years, and production continued to fall. And OPEC just gained more and more and more power and more market share. So they thought that they were fine. Just like today, production's falling. And I think, not to paint you with the consensus brush, because you're quite differentiated and quite contrarian, I would say. But in this case, I do think the consensus view is that we'll be fine because we have so much. Yeah, fine. Maybe production's declining a little bit now, but that's not really symptomatic of anything because we're so well endowed. And the question is, we were well endowed then too, but after you produce about 50% of your reserves, production falls. But think about it a different way. You still have everything that you've already produced to date sitting in front of you. It seems like a pretty good spot, and yet production, daily rates, tend to fall around that time. With shale, it could be even earlier because they have long tails. So it means that production peaks when less of the total reserve is produced. It could be as low as 38% we've seen in a lot of the shale basins. We're there now. So it's not really clear that we're out of the woods. I think that oil is probably still our biggest vulnerability. Yes, we're quote unquote energy independent today, but everything matters on the margin. If you go from energy independent to needing to import again, then you're susceptible again, right? I mean, I think it all matters on the margin. Uranium is the other one that jumps to mind because the U.S. is not a major producer of uranium. Canada is, so it's an allied nation, of course. Kazakhstan is. That is questionable. It's not a hostile nation by any means. I think people paint it with the Russian brush. I think it's a little premature. I mean, yes, it had Russian troops in Almaty to help settle dissent about a year ago or 2 years ago now. So a little bit of a shot across the bow, but it's I would say gray. Yeah. And so that's vulnerable. However, longer term, uranium is not the world's rarest element. And I think given enough time and enough capital, we ought to be able to bring on enough uranium production in domestic or allied countries to make that be okay. But there'll be huge dislocations in the middle, right? So I think oil is a little bit more structural, and uranium will be in a big bull market. We're big bulls on it with big core position in uranium producers. However, longer term price will take care of that market.
Yeah, I think some type of strategic move by Russia and Kazakhstan could be something that black swan that nobody's talking about. We'll
certainly
highlight that here. If something happens, but I do think it's something that not many people think about, but is I would say something that is, given how concentrated uranium is in Kazakhstan, a huge potential upside, potential tail.
I heard another one of our previous guests, Jeff Corey, talk about that in his mind, natural gas has kind of changed its role a bit. It's become sort of more the marginal price setter of some sort. That's how I remember his argumentation. Obviously, we know gas. There's a lot of LNG coming on stream. So I'm just curious about maybe this is also why, I don't know, oil prices seem fairly stable compared to what's going on in the world. I don't know. I'm just curious about it. And then my final question would be, do you know anything about Nord Stream? Is that more or less coming back online? I mean, as a Dane, I'm a little bit interested whether under the radar, they've kind of beginning to fix the Nord Stream pipe, and maybe with a deal with Russia soon, the Germans will be enjoying Russian gas again. I'm just curious.
It's really difficult to say. I don't know, and I don't think anyone knows. I think progress has been made. Look, I think that Europe is in a very difficult energy spot, and I don't think that's a big surprise. Germany is in the process of deindustrializing itself as we speak because of mistakes they've made in their energy program. Right now, it's all being made up with relatively cheap, stable, geopolitically stable U.S. gas. Then that could be at risk. If we start to see major, again, just think, okay, the gas market in the U.S. today is in deficit. We are taking gas out of inventory. This is not dissimilar from uranium a couple years ago. Okay, we had the gas in inventory, so it's not an acute shortage or crisis just yet, but we're taking gas out of storage at a pretty good clip. Production is falling year on year, and we are set to increase LNG export, not keep it flat, which would be a problem too, but increase it by as much as 7 Bs a day. And then we need another 7 to 10 BCF a day for domestic AI needs, which is obviously becoming, a huge focus of everybody. So I don't think the US will be overly keen to sacrifice its AI industry on the altar of cheap European gas, nor do I think production is set to increase in any time soon because of the geological reasons we've talked about. So I think there's a big risk that the U.S. is not the supplier of LNG that everyone hopes it is. That becomes kind of the swing factor, particularly with an administration like we have today. The U.S. consumes almost as much energy on a BTU basis in gas as we do in crude oil, and we have a price that's 80% below the world's price. That would be like, it's not dissimilar from Saudi Arabia, where they have $10 oil price gasoline equivalents, and the rest of the world's at 70 to 80. Why? Because they produce the oil. We produce the gas, so we get cheap natural gas. The difference that I tell everybody is that in Saudi Arabia, everyone's aware of it. And if something were to happen and they were to lose that, they'd be pissed. And here, nobody even realizes it. No one realizes that we train our models for much cheaper than anywhere else in the world, our computer models, because we have cheap natural gas. And we just had our building's annual general meeting. I promise you, none of the residents in my apartment building realize that we pay next to nothing to heat our hot water and apartments because of very cheap U.S. natural gas. If we were to lose that, I could see the administration curtailing U.S. exports very, very seriously. So Europe's in a tough spot, and I don't know what they're going to do. And I suspect that under the right scenario, you could see a crazy thing like Russian gas flowing back to Europe again. I don't think there's a resolve within Europe to tough it out. And I don't know where you're going to get the gas from. So yeah, I think anything can happen. I think we're in uncharted territories here.
Yeah. No, on that cliffhanger, I think it's a good time to say once again, thank you so much for a delightful, insightful conversation on so many important topics, and no doubt when we speak again in a few months, there'll be some new ones, but there'll also be some developments in the ones you've laid out so beautifully today. I want to encourage everyone to go and sign up for Adam's reports, and especially now that there's a new one coming out, you can find that on the Go Rosen website, and we'll of course also link to that in the show notes. They're always incredibly fascinating and insightful, so not to be missed. And as I told you before, Cem and I do these conversations because we really do feel that we are living in a global macro, but also in an energy-driven world, and it is possibly more important today to be up to date on these things than ever before. So stay well informed. From Cem and me, thanks ever so much for listening. We look forward to being back with you as we continue our Global Macro series. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.